Okay, so let's unpack something that, on the surface at least, just doesn't make a whole lot of sense. Because if you look at the headlines for London property in 2025, it's a bit gloomy, you know. Prime central London prices fell by an average of 3.4%. But then you zoom in on one very specific postcode.
Marylebone,
That
W1U.
Exactly. And suddenly the graph just goes the complete other way.
It really is an anomaly. I mean, while the rest of the prime market dropped to about 1,611 pounds a square foot, Marylebone actually climbed 9.6%.
Wow.
Yeah, it hit 1,833 a square foot. It's a massive divergence.
That is nearly a 10% jump, while literally everything around it is sliding. So the mission for you listening to this deep dive today is we need to figure out why. Like, why is this specific neighborhood defying gravity? Is it magic or is it structural?
Oh, it's definitely structural. The data really points to this being a masterclass in micro-market resilience. This isn't just random market forces. It's a very deliberate strategy to create a specific kind of place.
Right. And the sources call this the village effect, which, to be honest, sounds a bit like marketing fluff to me.
It does sound like that, yeah.
Like, does feeling like a village actually translate to hard cash value?
Surprisingly, yes, it does. But you really have to look at who is pulling the strings behind the scenes.
The Howard Walden estate.
Exactly. They're the major landowner there. And historically, they've taken this very counterintuitive approach to retail. They've actually rejected higher-paying chain stores to...
Wait, they rejected higher rent?
Yeah. They said no to top-tier rent, just to curate a mix of independent retailers.
Which is wild if you think about it. You're a landlord, and a massive chain offers you top dollar, and you say no just to keep the vibe right.
But that's the genius of it. By bringing in places like Dawn Books and local independent cafes, they prioritized community value over short-term rent maximization.
Ah, I see.
They realized that today, prime property value isn't just about pure status. It's about lifestyle density.
People want to live somewhere that actually feels like a real neighborhood. And the payoff is that Marylebone feels bustling on a Tuesday morning. Compare that to parts of Mayfair, which can feel a bit like a ghost town unless you're shopping for a very expensive watch.
Exactly. And that lived-in quality triggered the second big shift we need to talk about, which is the demographics.
Right, the buyers. Because for a long time, prime central London was basically the playground of the fly-in, fly-out international crowd.
And that's where the vulnerability lies for those other neighborhoods. With the recent changes to non-dom taxes and global capital retreating markets that rely heavily on international buyers are incredibly vulnerable.
But Marylebone rebalanced.
They rebalanced their buyer base to locals at exactly the right time.
So who are these domestic buyers? Are we talking young professionals or...
It's a mix. You've got UK-based downsizers moving in from places like Hampstead or St. John's Wood. You have professionals wanting a solid pied-à-terre. And you've even got families who prioritize culture and being central over having a massive garden.
And surely relying less on international money just makes the whole market safer, right?
Precisely. It creates a domestic demand floor that other luxury areas simply don't have right now. It insulates them from geopolitical shocks.
It probably also helps that, relatively speaking, it's still kind of a bargain compared to its neighbors, which brings us to the value arbitrage.
This is the math that really seals the deal. Even with that near 10% price jump, Marylebone is comparatively underpriced. Let's say you have 1 million pounds.
Okay.
That gets you about 596 square feet in Marylebone. But in Mayfair, that same million only gets you 417 square feet.
So you get nearly 50% more space, a better village vibe, and you're still right in the center of London.
Exactly. Though we should probably mention the new build effect here. You do have ultra-luxury developments like Chiltern Place hitting 5,000 pounds per square foot.
5,000. That is incredibly steep.
But the gap is narrowing. Buyers are starting to resist those huge new build premiums. Period stock, the classic older buildings, is trading around 2,000 to 2,400 per square foot. People are realizing the older stock might actually be the better long-term hold.
Now, before we tell everyone listening to go buy a flat in Marylebone, we definitely need a reality check. The sources mentioned this isn't exactly a roaring bull market, is it?
No, it's not, and that's a crucial nuance. Demand for properties over 3 million pounds is actually quite soft. This isn't a buying frenzy where absolutely everything sells.
Right.
The resilience is partly driven by a sheer shortage of quality stock. It's supply constraint meeting very specific focused demand.
So it's not that the whole market is booming, it's that this specific micro market just has the right ingredients to survive a downturn.
Outperforming a flat macro environment. The winning formula is curated retail, a domestic buyer base, and relative value.
So what does this all mean for you listening right now? I think the big lesson is to stop asking, is the market rising or falling? That's just too broad.
The question you should be asking is, which micro-market has structural resilience? Marylebone proves that even when the tide is going out, a well-curated ecosystem can still swim against the current.
Which leaves you with a bit of a provocative thought to chew on. If curation creates this much structural value, why are so many other landowners still chasing the highest rent check from generic chains instead of building a community that actually pays off in the long run?
That is the multi-million-pound question.
Thanks for joining us on this deep dive. We'll catch you next time.